Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited, and here's your weekly technical analysis of Chicago wheat and corn.
Chicago wheat. The bear channel, currently 549 to 624 for the February to date action, which is highlighted on my daily chart in bright red, has been the most significant pattern this year. Last week the market broke up through the upper bear channel line and confirmed the break higher by the end of that week. It did this by not only closing over the short medium moving average, currently at 656, but also the 50% absolute Fibonacci line at 682 and the flatlining medium moving average, currently 687. The move up over the 50% absolute Fibonacci line was intrinsically important, but it was also important in another way, as it was the gateway to the congestion band from March and April between 682 to 721, within which are the January 2021 high at 693 and the old October 2013 high at 721. This week prices followed on even higher from this break upwards by utilizing the medium moving average as a base to move up into another congestion band dating from December last year on through to February this year. Between about the March 2014 high at 725 up to the lesser Fibonacci line at 799, and containing the January 2022 low at 739 and the May 2014 high at 744. The market made it up into this congestion band, pushing up as far as over the March 2014 high. But then it ran into a piece of resistance, coming down that it could not easily overcome. The slowly declining long moving average, currently 754, and so far it seems we are holding just under this key resistance. This is where I discuss again an idea for what we have seen to be the construction of a possible new large pattern, which I mentioned last week. It is for a February to date and possibly an October 22 to date descending scallop pattern. This one has moved along quite rapidly from its infancy. Last week I gave some ideas for this pattern, and I quote, "The first level to watch and see if it develops is right around where we are, the 708 area. The second, that would be higher, around the mid 780s. More on this should it develop. I just want you to give you the heads up just in case." End of quote. Well, the 708 level did nothing. However, the 780 area, well, that still has potential, and this would be for the potentially larger October 2022 to date action. Personally, I suspect if we haven't had the declining long moving average, then this would have been a lot harder. That being said, we still haven't formed this pattern, and many things can scupper this idea before it happens. So what should we look for in case it does become a descending scallop pattern? Well, the market needs to hesitate to form a lip, if you will, and then after hesitating for a while, move in the direction of the ultimate pattern. Now this move can be both up and down, but it's important to note that little over 3 out of 4 times the subsequent move would be lower. That is what need to be seen in case this is a descending scallop pattern. However, I'm getting ahead of myself. First, we have to look at the targets on the top side of the previously mentioned bear channel. Thus, the primary target X would be in the 770 area, only a little above where we have reached. But the secondary target X1 will be a lot higher, up in the 855 area. And there's quite some congestion overhead, and one important downtrend, the March 22 to date downtrend, currently 845. This downtrend is the one based on the ultimate high of this market. We'll have to see if the market can achieve target X first. Chicago corn. The market's recovery last week was truly remarkable, and it has, to a certain degree, carried on into this week. We've seen over the last week or so prices punch up through the older congestion at 548 to 556 and 561 to 567 like they were not even there. The same happened at the end of last week and the start of this week, with more recent congestion from early May between 580 to 600. However, as I said last week about this congestion, I quote, "Apart from being recent, it's also not that strong, and it would not be surprising to see a move higher towards a wide band of stratified congestion from February through to April between 610 to 640, end of quote. I actually then continued, and I quote, beyond that comes the first big significant longer-term resistance, the 50% Fibonacci of September to May 2023 move at 655. In between any attempt there and where we are now, I hope we can see a new pattern emerge, perhaps a skeletal descending scallop pattern, but it's too early to see right now, end of quote. The market also punched up through the short medium moving average, currently at 571, and the medium moving average, currently 603, as well as the late February to date downtrend, currently at 607. All these, along with the 610 to 640 band, have slowed and even turned the market back down without the need of relying on the descending long moving average, currently above the market at 639, to cap prices. Now, the pullback this week has been, to say the least, initially limited, so it does require some further study of the market's actions to see if we are actually forming a lip as part of the descending scallop pattern. And by lip I mean the following. In case the market chooses to try and form a descending scallop pattern, it would first need to hesitate to form that lip, if you will, and then after hesitating for a while, move in the direction of the ultimate pattern. Now, this can be both up and down, but it's important to note that a little over 3 out of 4 times the subsequent move would be lower, and that is what is need to be seen in case this market does intend to form a descending scallop pattern. I have to say, if it does try to do this, then it will be an ugly looking one. And I'm looking at today's action, and I can see it's already pushing down to the next, back through the, well, it's below the medium moving average and a broken downtrend, and now through the next support in the 586 area. We have below this now the short medium moving average, and if we can maintain where we are now, then we could be looking at a potential lip being formed.
Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.